Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucy, and some of you know me as Triangle Investor from X. Today, I'm joined by Ben Finegold, Director of Ocean Wall. Ben, welcome to my show. It is great to have you here.
Thanks very much for having me, Lucian. Happy to be here.
Thanks. I would like to start with the current hot topic, and that is Paladin Energy agreed to acquire Fission Uranium at an implied equity value of 1.1, a little bit more, billion of Canadian dollars. What's your take on this deal, the valuation, and do you see a bidding war ahead?
I think that, above anything, this is great news for the sector. I think that, a lot of participants in the sector, investors, primarily have been waiting for M&A to really start to pick up again, primarily based on the fact that it was such a large part of the previous bull cycle. To sort of put some numbers behind that, there were about 100, so there are about 600 publicly traded names in the previous cycle,
Yeah.
uranium related in some capacity. Today there's about sort of 80, 85. So I think that consolidation that obviously took place after 2007 is still quite a concentrated market. And when you're getting high profile cases such as this, I mean, this would be regardless of whether it goes through at 130 or whatever it goes through at, or whether it goes through at all, is going to be a landmark deal for the sector. It will be the largest, definitely since I've been covering uranium in the last 5 years. I think it's the largest really in over a decade. So it's great news for the sector. It puts the sector on the radars of a bunch of new institutions that maybe event funds, people that are looking specifically at M&A. So it cannot be a bad thing. In terms of the specifics of the deal, as I mentioned, we've been working with Fission for the last few years. We're advisors to them. We love the company. We think
Yeah.
that PLS is a globally significant asset. I mean, we really think that Ross and the team that he's built there is best in class. I think that it's a team that most uranium developers would be envious of. So, for us, we're always looking out for the interest of our investors, and obviously, as our in our advisory capacity to Fission, trying to make sure that they get the best deal possible as well. But for the sector, it's great news. In terms of counter bids, I would not be surprised at all. These can sort of come from a few places, and when we talk about how consolidated the sector has become, you start to really look at who could buy who,
Yeah.
and in terms of the actual capital requirements for this kind of deal, you've really only got Cameco, NextGen, and Paladin that would be able to do this as a buyout. But obviously, there's opportunities for mergers from some of the smaller developers, and then outside of uranium is probably where I think would be the most interesting. So you started to see the likes of oil and gas majors start to get involved in the energy transition over the past decade, but really ramping that up over the past couple of years. The likes of Exxon building out lithium mines in Arkansas in the US. So I wouldn't be surprised to see some oil and gas interest in this deal. As they're sort of put under increasing pressure to show that they're trying to contribute to the energy transition. And then I guess the third potential participant is going to be your commodity traders, your sort of multinational mining companies, your BHPs, Glencores, Rios. Rios obviously have historically had an interest in this sector, so it wouldn't be surprising to see them sort of increase their current exposure. BHP have obviously got Olympic Dam. For someone like BHP, it really needs to be an asset that can move the needle for them on their scale, which again, there's sort of few and far between in the uranium sector in terms of companies that are able to do that. So I think there's various parties that are going to contribute to the M&A in the sector over the next few years, whether it's on the Fission Paladin deal, I don't know, but it's Fission for us has always been an attractive opportunity for M&A just because of the size of the deposit. I know that they released some news recently on their exploration summer drill program. So this could be potentially down the line a much larger deposit. We'll see, but it's great news for the sector, and we are watching with interest, as I know everyone else is.
Yeah, agreed. And interesting times ahead for Fission. Definitely, times have changed. Before with M&A, we had more cash deals, and today it's mostly equity deals. Why is that?
Mhm. Um, because the uranium sector hasn't generated much cash. Probably, I
Yeah.
mean, probably sort of one or two companies that have actually generated any cash. We always talk about uranium as, I think the global market cap of all the equities is sort of 66 billion. Um, you look at that in the context of a single oil major, and it's like it's a tenth of the EV of BP. But the reason that that might not hold much weight is because these companies generate a lot of free cash flow. Uranium companies haven't historically, and they haven't for the last sort of 10 years. So I think that why we're seeing more equity transactions versus cash transactions is there's just not that much cash in the sector. Um, I think that, I've always sort of spoken about this snowball effect. Rising prices incentivizes production to an extent to come online. And then you start to see meaningful cash flows generated by these companies, at which point more and more institutional capital can get involved in the sector. Again, without wanting to sound like a broken record, there's a clear supply demand imbalance between institutional demand for these stocks and the actual stocks that they're able to buy. So it's why you've seen, the likes of Cameco obviously outperform the sector. I think obviously Cameco, from an investment point of view, is interesting anyways, but you've got institutional appetite for these kind of stocks, and very, very few that you can get past your risk management teams because of liquidity constraints. So, the snowball effect starts with rising prices. Obviously, they've come off slightly, and maybe we can get into that, but starts there, and it's going to be, rising prices is what's going to start to bring cash flows back to the sector, and then down the line, maybe we'll start to see cash play a more prominent role in M&A transactions. But for now, a lot of these companies just don't have it.
Yeah, agreed. That was one of my next questions. Ben, what are you hearing and seeing about the current status of the spot market?
I think that whereas towards the back end of last year, it was incredibly thinly traded, and really there was just very few transactions, and we were seeing prices move up $5 on pretty much next to no volume. I think that there's a slightly different narrative playing out in the spot market today, in that liquidity's improved for sure. I mean, we were speaking to one of the main traders in the spot market last week, and it sounds like liquidity's quite strong at the moment. And even just reading some recent market commentary, we're seeing 400,000 pounds, but being traded, but not necessarily moving the price in the same way that it was at the end of 2023. So I think the liquidity is probably one of the key changes in the spot market at the moment. I think that investors have started to rightly understand that it's not the be all or end all for this thesis. Again, we're watching term prices. UXC have term prices up $2 for the month of June. Term prices have been on that same trajectory now for over 2 years or close to 2 years, just really either, I think it's 23 or 24 consecutive months now of either flat or increased prices in the term market. So I think, while the spot market definitely holds some precedent in terms of speculation and in terms of the price that speculators are willing to pay at that time, I think that rightly so, investors are starting to wake up to the fact that this is not the fundamental thesis, and this is not the outcome of the fundamental thesis. And I think that myself, alongside most investors and commentators on this space, I've been receiving 20, 30, 40 calls a day about, why uranium price is off. And my answer really is the same, is that the fundamental thesis is the exact same.
Exactly.
Nothing has changed there. If I saw term prices off $5, then there's a reason to worry. But they're not. As I said, they're up $2 this month. And for me, that is a more accurate reflection of what the price of uranium is, because it is utility demand. It is the price utilities are willing to pay for uranium. And rising term prices, in my mind, just means rising utility uncertainty around future supply. So
Yeah.
as I say, if that falls off $5, then maybe we'll be having a different conversation.
Yeah, sure. Can you expand a bit on the term market? How active is the term market now, and what are you hearing with RFPs, floors, and ceilings prices? Can you give me some color on that?
Yeah, I mean, utilities that we've spoken to recently, it's obviously not as active as last year yet, but I'm kind of viewing this slightly as kicking the can down the road. I think that we're going to see a huge surge in volumes in the second half of the year. Summer has typically been quite a weak period for the equity markets as well as term volumes.
Yeah.
But again, that starts to ramp up around September's WNA meet in London. Um, I think that utilities are in a relative period of calm. I've never loved the sort of panic narrative that utilities might be forced into this sort of panic mode. I think that while there is an element of naivety from some of the fuel buyers, potentially particularly in the US, I would say that European utilities are being sort of starting to become slightly more active. And there's various RFPs outside of just U308, but particularly in the UF6 markets that have been very, very, very difficult to fill, particularly at size, particularly in real volume. So I think, look, it would be wrong of me to sit here and say that I'm not surprised that term market volumes are where they are today, but I see this really picking up towards the end of the year. And we just talk about this word panic. I do feel that there's an element of utilities that are going to be flurrying to the term market at least at the end of the year. And if they're not able to do that, then again, you could see them in the spot market, but that sort of remains to be seen.
Okay, you mentioned institutional capital. In your opinion, when could we see that mainstream institutional capital flowing into the uranium sector?
I think that we have to an extent. I sort of talk about this in terms of innings. I would say that we're in innings 3 of 5, and for us to go to 4 and 5, you need those really large institutions to come in. I think that right now we're starting to see, I mean, blue chip, you know, the largest asset managers, the largest investment banks in the world, starting to show the sort of green shoots of real interest in this sector. And I'm not just talking sort of putting capital to work, but really hiring dedicated teams to start to look at this sector. Um, but I think that while uranium, in terms of institutional capital, has probably been the sort of been primarily used or invested in by commodity funds, let's say, on the institutional side, that the generics are going to start to come into this. Stuff like M&A and increased M&A activity is obviously going to contribute to that. But also, as I said, cash flows. We're
Sure.
starting to see drips and drabs come online in the US, and again, Paladin with the Langerheinrich restart, Boss with Honeymoon. We're starting to see drips and drabs of cash flows coming back to the sector, and we've got a few more coming online in the second half of the year now. While I don't think that this even gets close to solving the supply deficit that maybe we can talk about, it means that again, we're going to start to see cash flows back in the sector, and that's not something that we've seen for a very long time.
Yeah, agreed. I want to talk a little bit on the valuation of the uranium equities. We are seeing the explorers really lagging with some names at 4-year lows. Do you see re-rating of the explorers anytime soon?
Um, I mean, for the explorers, I guess the question is if you're coming into this sector from afar, you're coming into it new, and you say, I love this thesis so much. Why would I want to take exploration risk when you can take
Yeah,
some developers at pretty attractive discounts or pretty compelling valuations, I think. I think that the explorers, I mean, there's obviously some that have been massively oversold. I think for the explorers, it's always a case of being able to accurately convey drill results. And I think that that's something that is potentially lost on quite a few investors is really trying to pick up the value in the exploration sector by looking in detail at drill results and understanding geology. And that for us has been obviously a massive part of the work that we've done Lawson all over the past 5 years in this sector. But in terms of re-ratings, I mean, explorers will probably just do well as a result of underlying spot prices and also stuff like M&A. It really is a rising tide carries all boats. It's going to be when the sector's positive, these explorers will come back, but they are negatively impacted. That they are the impact of the downside is outsized for explorers during tough times, and that's always going to be the case. They are speculative
yeah.
for that exact reason. But having said that, when things go well, you get that outsized upside in explorers versus a Cameco or a Yellowcake or a Sprott. So it obviously works both ways. At the moment, with sentiment where it is and with the equities where they are, it's a painful time to be owning a lot of these juniors. But again, if you know what you have, which we do, then you're happy to sit on these and see some pretty attractive buying opportunities out there.
Yeah, good point. How do you actually value uranium exploration companies? You mentioned, of course, drill results are very important, but
Mm-hmm.
what other metrics are important to you when doing due diligence on exploration company,
Mm-hmm.
uranium exploration company?
Yeah, I've been fortunate enough to sit in on pretty much every junior or exploration company in the sector pitch to us. I think that at a sort of top line level is management and trying to understand management's experience and actually drilling. Again, going back to Fission, one of the things that we love a lot about Fission is that this is a team that has gone through this exploration process 3 times, have been successful. Um, so I think management is a massive part of that. Obviously, trying to
Agree.
understand geology, and I mean, I saw some commentary last night around sort of potentially some of the issues with Fission's underwater deposit, like the 2 largest North American mines are not called MacArthur River and Cigar Lake. So I think that, understanding the geology of these deposits, understanding the drill results, also understanding their capital requirements. I know, if you're in Canada and you've got the ability to raise capital quite easily through flow through, particularly charity flow through, then it does it does de-risk a lot of these from an investment point of view and from a valuation point of view, so their ability to raise capital.
Yeah,
But it's quite difficult to differentiate a lot of these explorers. I've been particularly impressed with some names like Sky Harbor as well, whereby Sky Harbor, you kind of, instead of having a single lottery ticket, you've got 20 goes at it. Really being able to de-risk your thesis there. So Jordan and the team there have been doing an exceptional job in sort of that project generator
yeah,
model, which I think is really interesting. With rising prices, we talk about incentivizing people to come to market and try and bring online new projects. I think that's the kind of company that could be a massive beneficiary of that. If you were a speculator, you wanted to go out and try and mine uranium, Sky Harbor is quite an interesting way or first port of call to go to, because they've got obviously this diversified portfolio of assets. So there's lots of different ways to play the exploration theme. We have tended at Ocean to stay away from it, just because we're so convicted in the underlying thesis that we don't like taking exploration risk. Whether that's the right thing to do or not, we'll see. But I definitely think that as a lot of the developers and producers reach or start to approach full value at current prices, at least, we'll start to turn and look at exploration as potentially a very the way to make outside returns in the later half of this bull run.
yeah, good point. Ben, how should new investors play the remainder of this uranium bull market? Just like you said, the explorers are risky. Some developers are fair, fairly valued, or some are even overvalued. So, how would a new investor on the market play the remainder of the uranium bull market? What's your take?
I think that, with prices at low 80s, I still think you need to have some spot price exposure, regardless of whether you're a believer that you should value things on spot or term. One thing that I'm a massive believer in is that you should not be valuing Yellowcake or Sprott purely on the spot price, but mainly because you couldn't unload 20 million or 60 million pounds in the spot market. These would
Yeah,
have to be sold under term prices in theory if they were ever to sell. So I think that you need to have some spot price exposure, but understand that these discounts to NAV are probably not as steep as people think. Now, if you are a uranium bull like we are, and I think like a lot of your listeners will be, you sort of think in your head, why do these things not trade at a premium? Which has been a question that I've grappled with for the last 5 years.
yeah,
But you have to have some exposure to spot price. Whether you want to pay that through Yellowcake or Sprott is really at your discretion. I mean, they're both at double-digit discounts to the net asset value if you're basing it on spot today. And then I think that there are some producer names, depending on what kind of allocation you're looking at. If you're an institution, I think you've got to have some Cameco exposure just because of the liquidity profile. And then moving down to some of the developers because I think a lot of the developers are quite fully valued at the moment. Fission is one that we're on the record as loving. UEC as well. Another one that we find really interesting, particularly given the sort of geopolitical backdrop. And I think, look, I mean, we talk about M&A. UEC could be a particularly interesting sort of string to pull. Whether Amir and Scott would entertain it, I don't know. But yeah, so looking for some value in the development stage would probably be another way to play it. Let's say you had 30% allocation towards physical exposure towards the spot price, and then 30% towards your sort of, you know, your value play developers. And then I wouldn't mind having a basket of exploration plays. I wouldn't want to take personally risk on a single name. I mean, I mentioned Sky Harbor because they have that diversified portfolio of assets. And then I think, again, we're in this trade because we're believers in nuclear power. So there are some really interesting downstream sort of nuclear reactor technology plays, supportive infrastructure for next gen nuclear, fuel enrichment, names that are going to be supportive of the next 50, 100 years of this trade that aren't necessarily reliant on the daily uranium spot price.
Yeah. I had John Champalia from Sprott recently in my show, and I asked him the same question. What is really today real incentive price of uranium that could really bring more mines online and boost supply? What's your take on that?
My take is that you have a uranium price today that incentivizes production, and that's not the problem here. The problem is bringing it online. And I think that 5 years ago, when I started in the sector, started covering the sector, it was the easiest job in the world to pitch uranium equities because the spot price was below the marginal cost of production, and you could see this nuclear renaissance, at least green shoots of it, starting to form, and you had uranium priced at a level that just did not incentivize even current production. All you could see was mines coming offline. So I don't think that today the argument is around cost of production. I mean, I think that at $85, $85 to $90, you can incentivize plenty of production. It's just a case of being able to bring these assets online in time.
Yeah,
I mean, I've been on the record and I'll go on the record again and say that we need 3 or 4 Kazakh size mines,
exactly.
8 to 10 million pounds a year to be able to supplement this deficit through 2040. I just do not see I do not see large volumes of uranium coming online before 2030. I think that the US, a country that mined 190,000 pounds of uranium last year, that has not mined scalable volumes of uranium for 30 years, if you think that they're going to be able to come on and just start to ramp up 20, 30, 40 million pounds a year, it's just not going to happen.
Yeah,
So you can start to look over at Kazakhstan and say, do we really understand the asset values in Kazakhstan? Can they not just ramp up? And I think that what's been abundantly clear over the past 12 months is that they're going through their own set of issues. This is a country that has been, Kazatomprom has been dedicated to building out these assets that really just had one job on the production side, and they were not able to foresee or able to foresee some of the issues that have come about from the Budanovskoye mine. I see various commentary about whether there is or isn't a supply deficit. You just need to go and run the numbers. And people talk about uranium demand like it's static at 190 or 200 million pounds, like it's not going to move anywhere. You apply a 3, 4, 5% CAGR, whatever you want to do to that. We're looking at 260, 270 million pounds by 2035. This could be 300 million pounds by 2050. Where are these pounds going to come from? I don't know. But again, we need a solution pretty quickly if
yes.
we're not going to see a fair few nuclear reactors shut down globally.
Yeah, you mentioned Kazatomprom. Do you believe that they will overcome all their challenges with sulfuric acid production cuts, etc.?
Maybe in time, not this year.
Sure.
I don't think next year either. Again, the numbers behind this are they need to double the current sulfuric acid requirements, so they need 1.5 million tons. Current production, they only produce 680,000 tons from their two sulfuric acid plants. So the third Balestra plant that was meant to come online in 26, I think was the first estimate, has now been pushed to 27. I would say it's going to go to 2028. Look, I think a lot is riding on, and I think this is not news to anyone, a lot's riding on Kazatomprom 2025 production numbers. My view is plus minus 5% from this year. I don't really see how they can go beyond 5%. Just quite simply, the capex numbers required to increase 5 to 10% or beyond is not in their financial statements. So the sulfuric acid issue for me has always been systemic. It's not a knee-jerk reaction. You can get your hands on sulfuric acid in certain volumes, but you're going to be paying a pretty high price for it. So again,
Yeah.
I mean, we're starting to see the project economics for Kazakh mines since, again, in the last 5 years since I started, these numbers have pretty much doubled when you're factoring in sulfuric acid costs, transport costs, and it still remains an incredibly competitive, economically competitive extraction method in Kazakhstan. But it's again, I think that the market is waiting to get some real transparency on this. And then another thing that we need to take a close look at, which we've done a lot of work on, is their inventory numbers and how they're going to be able to stabilize those. If that falls below the sort of 6 to 7 months of attributable production number that they normally have to keep, then that's another signal to the market that there might be a move around the corner.
Yeah. The part of the equation is also Niger. How do you see the Niger situation unfold? I mean, with Global Atomic especially, will they be able to produce without any problems, get their financing? What's your take on that?
I kind of view it in a similar light, which is that in time, yes, maybe. I've put sort of small volumes coming out of Dasa before 2030 into my supply demand model. I think that, look, you are dealing with a government that is making incredibly volatile decisions at the moment. So for me to sit here and try and predict what a military junta in military government in Niger is going to try and do is slightly out of my remit.
Okay.
But one thing is pretty clear is that seeing Irano's issues the past couple of weeks in wanting to start to redevelop Imarainen, then I don't see that I would envision that most other mines in Niger are going to face a pretty similar fate. One thing is for sure that financing is going to come at a pretty high cost, just given the risk associated with these projects now. So it's 25% of European uranium. It's not a small amount of uranium at all, and it's just sort of add that to the list of supply side fragility.
Yeah, we didn't discuss the enrichment. What can you tell me about the enrichment capacity? I mean, both operational and planned. How is the situation now, and how will this segment look in the years ahead?
Yeah, I mean, the Russian ban has obviously put that really into focus. I think that, estimates that I've seen is 7 to 10 years to be able to replace Rosatom, and that's across conversion and enrichment. I think that, we were fortunate on the enrichment side to be able to have some flex in that transition from underfeeding to overfeeding, post Russia's invasion of Ukraine. The thing that I think is perhaps surprising people is the lack of the lack of new projects, but really, Orano and all of these sort of enrichment companies have been firm since the very beginning, which is that we can't invest the tens of billions of dollars without firm commitments on EUP contracts into the future. Now, I think that that's probably going to start to change after the US ban, particularly in the US, where I wouldn't be surprised if we saw the announcement in sort of the next 6 months of a completely new enrichment facility there. Centrus have obviously been at the forefront of this, previously USEC, in trying to help solve that issue. I was in Atlanta a few weeks ago speaking to Urenco in sort of how their priorities stack. I was speaking to them specifically about HALEU and how that sits in terms of their priorities. And their priority is number one is LEU, for obvious reasons, that this is to feed the incumbent fleet in the US and globally. So I don't view enrichment as too large a bottleneck for at least for LEU at the moment. But unless we start to see capacity ramped up over the next sort of really the next 12, 18 months, at least announcing projects, then that's another issue that we could foresee in the next few years.
Okay, Ben, final question. What's your take on SMRs? Can we expect a boom here, or there are too many challenges to overcome for that going forward?
Yeah, so the reason I was in Atlanta is I was at the Reuters SMR conference, 700 delegates, all talking next gen nuclear. But I think my main takeaway was, there's no lack in terms of paper designs. There are designs that can work, that will work for SMRs. Really, your main constraints in getting these online is, first of all, understanding or trying to generate projects that make sense for both investors and customers, i.e. investors, but also at the utility level. And then the second sort of key takeaway was fuel. Higher, say, low enriched uranium enriched up to 19.75%, the only commercial supply being in Russia. There's just no supply chain for it in the Western world yet. So, overcoming those two hurdles is obviously, I mean, the future of SMRs is really contingent on overcoming those two hurdles. They're actually kind of symbiotic in a way, which is take Oklo, for example. Oklo based their initial project design on a $7,000 a kilogram HALEU price. With that, they were able to generate, they expected a 13% IRR. We estimate HALEU prices based on, if you take a SWU calculator on the Urenco website, we estimate SWU prices to be closer to $35,000 per kilogram. So this just drops your project IRR to zero pretty much. And then the reason I say that they sort of have a symbiotic relationship is we talk about trying to find projects that make sense for investors and customers. When you've got fuel prices that high, it's impossible. So, I think that we'll start to see maybe some LEU designs start to make real progress just because that's maybe the low-hanging fruit. But, maybe I'll add a third point to it, which is just a standardized regulatory framework. Just doesn't really exist yet for SMRs. We need to sort of put our heads together internationally. And I sort of sat on these conferences now for long enough to see the same things being brought up every year, but it's how can we actually put these into action? And I think that until such a time where these projects can show economic viability, the regulatory framework is not going to front run it.
Yeah, that was Ben Finegold from Ocean Wall. Ben, thank you for coming to my show. It was a great chat as I expected, and I hope to have you again sometime soon again. Thank you very much.
Absolutely. No problem at all. Thanks for having me.